Tirthankar Patnaik, Director and Strategist with Religare Capital Markets, joins us live with his take on Indian markets. Tirthankar, good morning. Thank you for joining us. Fantastic to have you back. Tirthankar, in quick time, Nifty has appreciated more than 900 points. Even though the core fundamental argument has not changed, the perception clearly has changed.
Nikunj, this has been a surprise to us. From a pure macro fundamentals perspective, one would have expected the market to come off meaningfully. Our own fair value portrays that the market should be at probably around 12 times forward earnings, but markets are north of 13.5, 14 times earnings forward multiples right now. Clearly, there is a lot of angle on liquidity that we have missed so far, and clearly the implications of a delayed US taper, which has also been helped by what has happened in US debt negotiations, has helped things along in this matter. And we are seeing flows to emerging markets coming up. So markets have really not gone on to fundamentals. It's basically liquidity driving the markets at the moment. And with a couple of results coming out well, markets have seen headline stocks doing well, and therefore that has also acted as another boost for the markets really.
Tirthankar, hi, morning. Up until now, we've been negating all sort of bad news flow. What's your sense on what could actually turn off this liquidity tap?
Well, if tomorrow the Fed actually comes up with a calendar on the taper, that would be the first big jolt that global liquidity balance will actually get on liquidity inflows. At the moment, all we know, or rather we guess, from a market perspective, is that one is unlikely, very, very unlikely to see any kind of a taper coming off before the year is done. What has also not helped in that matter is that Janet Yellen, instead of Larry Summers, is the next Fed chief, who is seen as a dove along those matters, and therefore one probably expects the liquidity taps to remain on for now. So that would be from a global perspective. I'm taking out any kind of global negatives from a geopolitical risk, which is not something we would like to foresee at the moment. But from an Indian perspective, one would see sectors with asset quality issues like banks, sectors where volume growth might be at risk, could be dampeners in the current rally really. That's how I have surmised it from a domestic and global perspective. Yesterday's inflation numbers have been fairly weak, much higher than expectations on consensus. Our numbers were marginally higher, but inflation numbers have come in higher. So expectations on a rate hike on 29th have basically risen. That could again be a dampener for the markets really.
You're right, Tirthankar. Globally, markets have clearly rallied against fundamental odds, but the perception for global liquidity has changed, and it's not only India, other emerging markets are also benefiting. So, Tirthankar, what is a prudent course of strategy in this kind of a market? Because those who are trying to, track market fundamentals, they've not participated, but those who've ignored fundamental concerns and have participated, they are better off.
Yes and no, Nikunj. See, our portfolio tilt is heavily overlaid on IT and pharma, and these are sectors that have really done well. I mean, I would not discount the fact that we are underweight on banks, and banks have rallied meaningfully from the index levels of 5100, 5200, and from there, private banks especially have done fairly well. We remain underweight on banks, and that has hurt our model portfolio positioning. But IT and pharma, I must say, have done fairly well. And INFI, for instance, where we have a 250 basis point overweight from the benchmark Nifty, has done fairly well. And if TCS also comes up with blockbuster numbers, portfolios that have IT and pharma as their tilt would be doing probably well also. So what I'm trying to say is that this is a market where you would have banks performing as well as IT and pharma performing. This is a very curious market, given liquidity concerns. Liquidity is so abundant. PSU banks would be one place where the beta factor is basically rising. In other words, if asset quality does surprise on the positive side rather than the negative side, the beta there would be significant. And I must say we will be losers there. But for private banks, one would have expected some amount of a jump going forward also. So, this is a market, I must repeat, where IT and pharma would perform on one side, and so would rate cyclicals to some extent.
What is so special about Bata?
So I guess they have an expansion plan in place. They, from a top-down perspective, fit into the larger theme of consumption. So, we like Bata from a top-down perspective from that angle. And our analyst likes the company purely because of the expansion plan. It's in place. Margins are likely to go up. The company manages its costs fairly well, and valuations are not really that expensive. And this is another theme that we would like in Bata is consumption in the slowdown is basically downtrending. So instead of buying a house, you buy a car. Instead of buying a car, you basically go out and eat. And from that perspective, again, those stocks that are down below in the value chain in the consumption cycle are basically seeing spurts of revival, and Bata fits very well into that theme. The worry we would say about Bata would be that the space is becoming crowded. There are players in the space which have more than the 1,000 crore plus revenue players in the footwear space is basically rising, and which is why Bata should see competition going forward over the next couple of years. But at the moment, we see Bata is in a sweet spot where it has a pan-Indian presence, and and in an environment where consumption remains fairly good at that particular level. This is a company that's expanding. So we like Bata that way.
Tirthankar, what explains the rally in the entire mid-cap PSU banking pack yesterday?
My read is that from a PSU bank perspective, there is thought that the RBI governor has pointed out that he would open the banking space more. There would be foreign banks which would be allowed entries, and all candidates, Karnataka Bank, Federal Bank, and the others of their ilk, which basically are seen as acquisition candidates by foreign banks, basically saw the spurt. This, to my mind, from a framework perspective, comes into fits very well into what the governor actually said in his very first press meeting, that he would basically see the banking space being opened up. So we are talking about a fundamental change in the Indian banking space, where the new entrants in the Indian banking basically would be available on tap. The numbers would be much higher than current levels. Completely contrary to what the RBI has been doing over the last many years, where Kotak and Yes probably were the last banks, and so that is one. And the second part is that foreign banks also will have a significant presence here. Branch restrictions, he already has alluded, would be taken off. Today, every foreign bank can open only about 12 branches a year, and we are likely to see those numbers increase very substantially. There are about 300-350 branches of foreign banks in this country versus an overall total of around 82,000. So we clearly see foreign banks coming up, and it is not surprising that these acquisition candidates, as they were considered by the markets, did very well.
Give us your top recommendations when it comes to the IT pack, given the outperformance in Infosys post the earnings and in TCS ahead of the earnings.
So, we have a three-pronged strategy on IT, wherein, we are pushing stocks which have consistently done well, like TCS on execution. We like stocks that are a turnaround story, like Infosys, where we prefer Infosys over Wipro. In terms of execution, we like TCS over HCL Tech, and then we like bottom-up stories, where a stock has been, small in size and now growing big, and will probably command large-cap valuations like Tech Mahindra. So in terms of a pecking order, we continue to prefer Infosys. TCS is where we are on the margin. Our analyst says that he would be taking off some money. We will not be putting in probably fresh money at these levels. But as I said earlier, we have a 150 basis point overweight on TCS from a model portfolio perspective over the benchmark, and on Infi we have a 250 basis point overweight. And